Welcome everybody to the 40 Finance channel. My name's Jeff Beers, and today I'm looking at 5 software stocks that will provide you with consistent returns over the next 3 to 5 years at least. These companies generate predictable revenue streams every single year. They're a great addition to your portfolio. So let's jump right in. Okay, first on the list today is Adobe. And Adobe's been in the game for quite some time. They've always managed to innovate and change their offerings from Photoshop to PDF creators. Now they're into the next iteration of marketing platforms, CRM platforms, video, you name it. Adobe is at the cutting edge, and it's one of the key tool sets for all creative companies across the globe. And what I think most about Adobe is their recent switch in the past couple years to a monthly subscription model for a lot of their consumer level packages. And basically what this means is it takes a product where they used to have to re-engage everyone as their license expired to now it just keeps producing income time and time again. People get to a certain level, even on the basic Photoshop plans, where they simply have to have Adobe in order to, reach their creative goals. So it's a great model, and it goes across dozens of their different software properties. And you see here, when we look at Adobe stock, this is a 5-year chart. And in this 5-year stretch, it's been nothing but up for Adobe. Now, it's a little different than a cheaper stock that could have massive highs and lows. The growth is a little bit sequential and incremental. You're not going to wake up one day and Adobe's going to grow 100% or maybe not even 50%. But what you can expect is a solid foundation that continues to build year after year. They continue to be called a growth stock in the sense mostly because they don't pay a dividend, and we're not sure if they ever will. From a PE perspective right now, Adobe's a little high at 50.89. However, the forward PE drops this year to 28.31, so that's a very strong sign that it's going down. And as far as price targets, I think here entering summer for the stock market, we can expect to see a dip at some point. All the China talks and frankly just interest rates, all the environment that's going on right now is a little unstable in my opinion. And I feel like a lot of stocks are up very close to their highs. And that's what I would put Adobe in this category as well. However, I've included dip targets on all the stocks featured here today. For Adobe, I would say if you're saving money and you're waiting for the next dip, you're trying to get this one about 259, which brings some of that PE down a little bit. But even beyond the dip target at 259, I think no matter when you buy Adobe over the next 12 to 15 months, you're looking at a solid stock if you plan to hold it for 5-10 years. I don't think you can go wrong. They make quality products. They have recurring billing models. The future looks really good. All right, next on our list needs very little introduction, the Microsoft Corporation. So Microsoft, similar to Adobe, has taken a lot of their Office suites, Microsoft Word, all the different things that they do, and they have also switched to monthly and annual recurring subscriptions for consumers. And what that means is a lot more predictable growth. And Microsoft's, they're far from just a one-trick pony though, because after you get out of Office and after you get out of the software platform, they also have a very competitive cloud computing application that they sell to corporations. Obviously, you have their gaming division with Xbox. You have platform type stuff with the Microsoft Surface. So they're a well-diversified company. And right now, the stock is trading at a PE of 29. That goes down to about 26 over the next 12 months. So not too bad, still a little high. But if you're looking ahead to dips and targets, I think you'll be able to get Microsoft at some point this year really close to $110 on the next downturn. And at that level, I think honestly, it's just a great bargain. I would still buy this stock today at 132, knowing that I would hold it for 5 or 10 years. And with that in mind, I don't know how granular you have to get on the current price. You get a dividend of 1.49%. You get a company with solid foundation, recurring revenue streams already built in, and the whole universe of cloud applications to provide even more revenue going forward. So great stock here with Microsoft. All right, next on the list today is Salesforce, salesforce.com. And Salesforce, if you're not familiar, is basically made for sales industry professionals. It's almost like a contact CRM based software, but they've also expanded out to a lot of different applications. They have a customer service platform. They have their own sort of cloud business management platform. And just like the other ones, and the reason that we like these software stocks is it's a model that keeps building on itself. Once you have a customer, the lifetime value of a software customer, if you're delivering a quality product, is absolutely insane because they keep renewing, they keep resubscribing. Now, Salesforce is on definitely one of the more expensive offerings here right now. The PE is over 100 at 102.4. However, the forward PE drops all the way to 43.72. So I think with that in mind, you're looking at a company where the bottom line or the profits are starting to grow heavily over the next couple years. So I expect the stock to continue to go up. You see on the 5-year chart that they have an outstanding track record right now. But if you're looking ahead to dips, you're going to struggle a little bit to see Salesforce take a massive dip just because it's such a darling right now in the software space. If you can get it at 145, I think you're doing pretty good. And anything under that, I think it's a solid buy, recognizing, of course, that the profit taking for yourself is going to be anywhere over the next 3 to 5 years, but it's a safe, sound investment in the software space. Okay, next on the list is a company, Intuit. So Intuit makes QuickBooks, lots of small business accounting / payroll software services. They've been around for a long time. You see their 5-year chart, nothing but upswings. The only dip here, they quickly recovered and now they're back up. So Intuit, very solid platform. They also make TurboTax. And they just have such a base of customers right now that everything they release is basically it gets bought the second it comes out. So the only thing I would look for Intuit over the future is maybe some expansion of the QuickBooks library, TurboTax, all those things I think are pretty solid over the next 3 to 5 years. But eventually they're going to have to add some new tricks up their sleeve. And I think they have some of those ideas brewing. It'll just be interesting to see when they launch. From a PE ratio standpoint, you got about a 46 PE ratio right now for Intuit. That does drop to 33.70 over the next 12 months. And for a dip target, we've seen Intuit take some minor ebbs and flows. I would say it's a little bit more volatile than the other stocks that we've talked about so far today. However, if you can get in at the 238 mark or somewhere below that, I think you're getting a great deal. You get a small dividend of 0.77%. That will likely increase as time goes on. But overall, I don't think you can go wrong with Intuit as a safe stock to produce predictable returns over the long term. All right, last up here is more of a developing stock that's come out, Checkpoint Software Technologies. This is an Israeli-based company, and they make a lot of secure cybersecurity type applications. They're really hot right now as far as generating profits and new income streams. And while this 5-year chart shows you that it doesn't have the same fundamental upward swing as the other 4 stocks I featured, they are really an up-and-coming company that I think will eventually, over the next 2 to 4 years, they will start to become the next Intuit or, Semantic, something like that, where the recurring revenue streams will make their profit growth a lot more predictable. Right now, you got a PE ratio of 22.03 with a forward PE at 17.57. There is no dividend because it's considered a growth stock. And if you're looking ahead for a dip point to get, I think you can get at 102 or below, maybe even under $100 for Checkpoint, simply because it's not as unstable ground as some of the other ones are. But I think what you can see with Checkpoint is a lot more growth, sudden growth to happen over the next 12 to 24 months, because they are much more of a growing company compared to like an Adobe that would have to land, you know, millions and millions of dollars of brand new contracts to show the same growth that a Checkpoint software would. So keep this one in mind if you're looking for something a little different at a lower price point, but with more growth potential in the future. All right, guys, so that's 5 software stocks that we have today that'll produce consistent returns in your long-term portfolio. Software companies are excellent for predictive revenue, predictive profits, even in the worst of times. So if you're looking ahead to the unstable market we have right now, you're looking for dip points in what you might buy when the market is unsettled or possibly in a downturn, I think a few of these software stocks would be excellent contributions to your portfolio. Hope you enjoyed this. Please like and subscribe, share with your friends. Really appreciate your support. We'll see you on the next video.